Hey everyone, welcome back. Today we're tackling a topic that, let's be honest, can be a little intimidating, especially in times like these. We're diving deep into investing during a recession.
Sounds scary, huh?
Well, it can be, right? Nobody likes seeing red arrows pointing down in their portfolio. But that's why you're here. You're our financial expert, our guide through these choppy economic waters.
I'll do my best to navigate us. But first, I think it's important to remember that recessions, while challenging, aren't necessarily all doom and gloom.
Okay, that's a good point. I think sometimes the news can make it feel like the world is ending when the economy takes a dip.
Right, exactly. But it's important to remember that recessions are a natural part of the economic cycle. They've happened before, they'll happen again, and smart investors can actually use them to their advantage.
There's that silver lining everyone keeps talking about. So let's get into some specifics. One piece of advice I hear a lot is to focus on consumer staples during a recession. But I'll be honest, I'm not entirely sure what that means.
Yeah, it's a bit of a jargon term, isn't it? Basically, it refers to those everyday essentials that people always need, regardless of the economy. Things like groceries, toiletries, household cleaning products, that sort of thing.
Okay, so the things you can't really cut back on, even when you're trying to tighten the budget.
Exactly. And companies that produce these essential goods tend to perform relatively well during recessions, even when other sectors are struggling.
So if I'm looking to invest during a recession, I should be thinking about stocking up on, well, not literally stocking up, but, investing in the companies that provide those staples.
Precisely. But it's not quite as simple as just buying any grocery store chain or any cleaning product company.
Hmm.
You have to be a bit more strategic.
Oh, how so?
Well, think back to the last recession, for example. Discount retailers and generic brands actually thrived while premium brands struggled. People were still buying essentials, but they were much more price conscious.
That makes sense. So it's not just about the product category. It's about understanding how consumer behavior shifts during a recession.
Exactly. You need to anticipate those shifts and position yourself accordingly.
Okay, that's a great insight. So consumer staples with a focus on value and affordability. Got it. Now, what about healthcare? That seems like another area that's pretty much recession-proof.
You're absolutely right. People still get sick, they still need medication, they still go to the doctor, regardless of the economy. So healthcare as a sector is inherently resilient.
Right. It's not like you can just put off going to the doctor if you break your leg just because the economy's in a slump.
Exactly. But even within healthcare, there are certain areas that are poised for accelerated growth, even during a recession. Things like telehealth, for example.
That makes sense. People are looking for more convenient and affordable healthcare options, especially when money is tight.
Precisely. And then there's the aging population, which is a huge demographic trend that's driving demand for healthcare services across the board.
So, healthcare, with a focus on innovation and demographics.
Got it. Now, let's say I'm feeling a little more adventurous. Are there any investment opportunities during a recession that are a bit, well, spicier?
You're talking about real estate. And yes, recessions can actually create some very attractive entry points in the real estate market, particularly in the rental sector.
Okay, I'm listening. Why rentals specifically?
Well, think about it. When the economy takes a downturn, people often delay buying a home. They might be worried about job security, or they might not be able to qualify for a mortgage as easily, so they end up renting for longer.
So the demand for rentals goes up, even when the overall economy is down.
Exactly. And on top of that, if property values dip during a recession, you might be able to snag a rental property at a discount.
Okay, so that's the buying opportunity everyone keeps talking about. But doesn't a recession also mean more people are struggling financially? Could that lead to missed rent payments or even evictions?
It's a valid concern, and it's why careful analysis is key. You don't want to just jump into any rental property. Right, it's not just about finding a cheap house. It's about finding a good investment.
Exactly. You need to look at areas with stable employment, even during a recession. Think about industries that are recession resistant, like healthcare, education, or essential services.
Okay, so location is key. Anything else to consider?
The type of property also matters. Affordable units tend to fare better than luxury rentals during downturns. People might be cutting back on expenses, but they still need a roof over their heads.
So it's all about strategic selection, not just blindly jumping into any rental property. Makes sense. Now, let's tackle the big one, stocks. Are those even worth considering during a recession?
It's a common question, and the answer is, well, it depends. While it's true that the stock market tends to be more volatile during recessions, remember, not all stocks are created equal.
Ah, okay. So it's not a black and white, stocks are good or stocks are bad situation.
Exactly. You have to be more discerning. Think about blue chip stocks, for example.
Blue chip stocks, those are the big established
Oh,
companies,
yeah.
right?
Precisely. Companies like Apple, Microsoft, Coca-Cola. These companies have a long history of not just surviving recessions, but often emerging even stronger.
Okay, so their size and stability provide a bit of a buffer during turbulent times. But even those companies take a hit during a recession, don't they? I mean, their stock prices still go down.
Of course, there will be fluctuations, but their strong fundamentals, their market dominance, these things often make them safe havens for investors seeking stability during a recession. And here's the key. You can often acquire these stocks at lower prices during a recession.
Ah, so it's like a blue chip sale. Wait for the prices to dip, buy in, and then potentially reap the rewards when the market recovers.
Precisely. It's a strategy that requires patience and a long-term perspective, but it can be very rewarding.
Okay, that makes sense. So blue chip stocks bought strategically during a downturn. Got it. But what if I'm not quite ready to dive back into the stock market? What about bonds? Aren't those supposed to be the safe option?
Bonds are generally considered less risky than stocks, especially government bonds. They typically offer lower returns, but they can provide a steady stream of income and stability, especially when the stock market is going haywire.
So bonds for stability, stocks for potential growth. Got it. But I have to admit, I always thought bonds are pretty straightforward. You just buy them and collect your interest payments, right?
Well, it's a bit more nuanced than that, especially during a recession. You see, interest rates often drop during a recession.
Okay, so how does that affect my bond investments?
Well, let's say you lock into a long-term bond at a higher interest rate before the recession hits. You'll be earning more than someone who buys a bond at a lower rate during the recession.
Ah, so it's about timing. Buy high, sell low, right? Or is that the other way around?
No, it's not quite the same as buying and selling stocks, but the principle is similar. You want to be strategic about when you buy bonds, especially during times of economic uncertainty.
This is all getting a bit complex. I thought investing during a recession was supposed to be about simplifying things, sticking to the basics.
It's definitely about being more mindful and strategic. And remember, no investment is entirely risk-free, especially during a recession. That's why diversification is so important.
Diversification, right. Spread your bets across different asset classes. Don't put all your eggs in one basket. But doesn't that also mean spreading out your potential returns? If everything goes up, wouldn't I be better off going all in on the biggest winner?
That's where risk tolerance and a long-term mindset come in. Diversification isn't about maximizing returns in every single scenario. It's about building a portfolio that can withstand various economic shocks. It's about staying in the game, even when the game gets tough.
So it's about riding out those ups and downs without losing your shirt.
Exactly. And coming out the other side with a portfolio that's positioned for long-term growth.
I like that. But practically speaking, how do I even begin to diversify? Where do I start?
Well, a common approach is to allocate a portion of your portfolio to each of the asset classes we've discussed: consumer staples, healthcare, real estate, blue chip stocks, and bonds.
So a little bit of everything spread out like a buffet.
Yeah,
But I'm guessing the exact proportions depend on my individual circumstances, right?
absolutely. Your risk tolerance, your financial goals, your time horizon, these all factor into the equation.
Okay, so no one-size-fits-all solution. It's about finding my own personal balance. But I'm guessing there are some common pitfalls I should be aware of. Mistakes people often make when trying to diversify.
Definitely. One of the biggest mistakes is not diversifying enough. Some people think that holding a few stocks, even if they're different companies, is enough. But if those stocks are all in the same sector and that sector takes a hit during a recession, your entire portfolio suffers.
Ah, so it's like having a basketball team full of amazing shooters, but none of them can dribble or defend. One weakness brings down the whole game.
Exactly. You need a well-rounded team, a well-rounded portfolio. Another common pitfall is being too conservative.
Too conservative. What do you mean?
Some investors, fearful of risk, stick solely to low-yield assets like cash or money market accounts. While those offer stability, they might not provide enough growth to outpace inflation, especially during a recession when inflation tends to rise.
So it's about finding that sweet spot between protecting your money and actually growing it. Easier said than done, right?
It takes some finesse, but that's where a good financial advisor can really come in handy.
Okay, we'll definitely come back to that later.
Yeah.
But any other diversification blunders we should be aware of?
Ignoring international markets. A lot of investors naturally focus on their home country. But remember, recessions don't always hit every country simultaneously. Investing in international markets can provide a buffer if your home market is struggling.
So it's like having a backup generator in case the power goes out in your neighborhood.
Precisely. It spreads the risk and potentially exposes you to growth opportunities in other parts of the world.
That's smart.
Yeah.
But I'm guessing picking the right international markets is a whole other deep dive.
It is. But that's a conversation for another time. For now, let's shift gears a bit and talk about the emotional roller coaster that comes with investing during a recession. It's hard enough watching your portfolio fluctuate during normal times, let alone when the whole economy feels like it's on a downward spiral. How do you stay sane when everything feels like it's going wrong? You've hit on a crucial point. Emotional resilience is just as important as financial strategy during a recession. Seeing your investments drop can trigger fear and panic, which can lead to impulsive decisions that might hurt you in the long run.
So it's not just about what you invest in, but how you react when things inevitably go wrong. Easier said than done, right?
It definitely takes practice. One way to stay grounded is to remember your long-term goals. Why did you start investing in the first place? What are you hoping to achieve? Focus on that vision, and it can help you weather the short-term storms.
It's like having a compass that points you in the right direction, even when the winds are howling. But let's be real, seeing your hard-earned money seemingly vanish is stressful. Any practical tips for managing that anxiety?
Absolutely. One thing you can do is limit your exposure to the constant news cycle. It often amplifies negativity, creating unnecessary stress. Stick to reliable sources for updates, but don't obsessively track every market fluctuation.
So it's like taking a social media detox, but for financial news.
Exactly. Give yourself a break from the noise and focus on the things you can control. Another tip is to focus on your financial plan. If you've got a solid plan in place and you're sticking to it, that can provide a sense of stability and control even when the market feels chaotic.
So it's about having a roadmap, even when the terrain gets bumpy. But what if I'm still feeling overwhelmed? Is it ever okay to just hit the pause button on investing altogether during a recession?
That depends on your individual situation and goals. If you're nearing retirement and need to access your investment soon, a temporary pause might be prudent. However, for long-term investors, remember that recessions are buying opportunities. Pulling out completely could mean missing out on those discounted prices that fuel future growth.
So it's a judgment call. Assess your personal timeline and risk tolerance before making any drastic moves. But let's say I'm committed to staying invested during a recession. Any other strategies for staying calm and collected?
Focus on what you can control. You can't control the economy, but you can control your spending, savings, and investment choices. Make a plan, review your budget, and stick to your strategy. Taking action often helps alleviate anxiety.
So it's about being proactive instead of reactive. Instead of just letting the recession happen to you, you're taking steps to manage it, to navigate it on your own terms.
Exactly, and that sense of agency can be very empowering, even in challenging times.
Okay, so we've got our mindset in check, we're focusing on the long game, and we're taking proactive steps to manage our finances. Anything else we can do to feel more financially secure during a recession?
One thing that's often overlooked is exploring additional income streams. This could be a side hustle, freelancing, or even monetizing a hobby.
So it's like having a financial backup plan in case your primary income takes a hit.
Precisely. And even a small additional income stream can make a big difference in your overall financial well-being, especially during times of economic uncertainty.
Okay, that makes sense. So we've covered a lot of ground here, from diversifying your portfolio to managing your emotions to even exploring new income streams. It feels like we've given our listeners a solid toolkit for navigating a recession. But before we wrap up this part of our conversation, I want to circle back to something we touched on earlier, that idea of seeking guidance from a financial advisor. It seems like having an expert in your corner could be especially valuable during a recession, right?
Absolutely. Financial advisors bring a wealth of knowledge and experience to the table, and they can help you navigate the complexities of the market in a way that aligns with your individual goals and risk tolerance.
So it's like having a personal trainer for your finances. They help you create a plan, stay on track, and make sure you're making the right moves.
That's a great analogy. And they can also provide emotional support, which can be incredibly valuable during a recession when fear and uncertainty are running high.
Yeah, sometimes just having someone to talk to, someone who understands the financial landscape, can make all the difference. But let's be honest, financial advisors can be expensive, can't they? Is it really worth the investment, especially if I'm already feeling financially stretched?
It's a fair question, and the cost of financial advice varies widely. It's important to shop around and find an advisor who fits your budget and needs. But remember, a good financial advisor can potentially save you money and stress in the long run.
So it's like any investment, you have to weigh the costs and benefits. But how do I even find a good financial advisor? It feels like there are so many out there, it's hard to know where to start.
You're right, there are a lot of options. One place to start is by asking for referrals from friends, family, or colleagues who have had positive experiences with financial advisors. You can also look for advisors who specialize in your specific needs, whether it's retirement planning, investment management, or debt reduction.
So it's about finding someone who speaks my language and understands my financial goals. But let's say I've found a potential advisor. What questions should I ask them to make sure they're a good fit?
That's a great question. You'll want to ask about their experience, their fees, their investment philosophy, and how they communicate with their clients. It's also important to make sure you feel comfortable with them personally. After all, you'll be sharing sensitive financial information with them.
So it's not just about their credentials, it's about that personal connection too. You need to feel like you can trust them, that they have your best interests at heart.
Exactly. It's a relationship built on trust and mutual respect.
Well, we've covered a lot of ground here today, from the nitty-gritty of diversification to the importance of emotional well-being to the benefits of seeking expert guidance. I feel like we've given our listeners a really comprehensive overview of how to approach investing during a recession. But before we wrap up this part of our discussion, I want to circle back to something you said earlier, that idea of recessions being buying opportunities. Can you expand on that a bit? What makes a recession a good time to invest, even when things feel so uncertain?
That's a great question, and one that goes to the heart of understanding market cycles. You see, recessions are often characterized by fear and pessimism. Investors get spooked, and prices drop, sometimes significantly. But here's the thing, recessions are temporary.
So it's about having the courage to zig when everyone else is zagging. But how do I know what to invest in during a recession? Isn't everything going down?
That's precisely what creates the opportunity. When fear drives prices down, savvy investors recognize the chance to acquire assets at a discount. They see beyond the headlines and focus on the long-term potential.
Okay, I'm starting to see the logic here. But it takes a certain mindset, doesn't it, to see opportunity when everyone else is panicking?
It does. It takes a long-term perspective, a belief in the cyclical nature of the economy, and a willingness to go against the herd.
So it's not for the faint of heart.
It definitely requires some courage and conviction, but for those who are prepared to ride out the storm, recessions can offer incredible opportunities to build wealth.
That's a powerful message, and one that I think will resonate with our listeners. It's not about denying the challenges of a recession, but about recognizing that within those challenges lie opportunities for growth and resilience.
Precisely. And by approaching a recession with a proactive mindset, a well-defined strategy, and a willingness to seek expert guidance, you can not only weather the storm, but potentially emerge stronger on the other side.
Well said. This has been an incredible deep dive, packed with actionable insights and a healthy dose of optimism. But before we wrap up this part of our conversation, I want to leave our listeners with one final thought. If you're feeling overwhelmed by the prospect of a recession, remember, you're not alone. There are resources available to help you, whether it's financial advice, educational materials, or simply the support of friends and family. And we'll be right back after a short break to continue our deep dive into investing during a recession.
That's a crucial point. Remember, we're all in this together. And by sharing knowledge and supporting each other, we can navigate these challenging times with greater confidence and resilience.
Okay, we're back. And I have to say, that last point about recessions being buying opportunities really got me thinking. It's like a whole new way of looking at a downturn. But before we get too carried away with bargain hunting, let's talk about something equally crucial: being prepared before the recession even hits.
You're absolutely right. Proactive preparation is key. It's like reinforcing your house before the storm, not during. You want to be ready when the winds start howling, not scrambling to board up the windows when the hurricane is already upon you.
So what does that financial reinforcement look like in practical terms? What are some steps we can take to prepare our finances for a recession?
Well, we touched on emergency funds earlier, but it's worth emphasizing again. Having that financial cushion, those liquid assets you can easily access, can make all the difference when unexpected expenses arise, especially during a recession when job security might be shaky.
It's like that safety net they tell you to bring when hiking in the mountains. Right. You might not need it, but you're sure glad you have it if you trip and fall.
Exactly. You never know when you might hit a rough patch, and having that emergency fund can give you the peace of mind to navigate those challenges without derailing your long-term financial goals. And beyond the emergency fund, take a good hard look at your budget.
The dreaded B word. But yeah, I guess a recession is a good time to get serious about budgeting, isn't it?
It is. Are there areas where you can trim the fat, so to speak? Maybe those subscription services you barely use or cutting back on dining out a few times a week?
So it's about tightening the belt a bit preemptively, just in case things get rough. But isn't there a danger of being too frugal? I mean, if everyone stops spending, wouldn't that make the recession even worse?
It's a delicate balance, for sure. Being mindful of your spending doesn't mean halting it altogether. Remember, consumer spending is a huge driver of the economy.
Right, so it's not about becoming a total Scrooge.
Exactly. It's about being financially savvy,
Mm.
prioritizing needs over wants, and ensuring you have a solid financial foundation to withstand potential income disruptions.
Okay, so spend wisely, but don't hoard your cash under the mattress. What about debt? That's a big one for a lot of people. Should we be scrambling to pay it all off before a recession hits?
High-interest debt, like credit cards, should definitely be a top priority. Recessions often bring rising interest rates, making that debt even more burdensome.
So tackle the debt while it's still manageable before those interest rates start climbing like a roller coaster.
Exactly. Focus on those high-interest debts first and create a plan to pay them down as quickly as possible.
Okay, so we've got our emergency fund, we've streamlined our budget, and we're chipping away at our debt. Anything else we can do to proactively prepare for a recession?
Well, remember those additional income streams we talked about earlier? This is a great time to start exploring those options.
Right, the side hustles, the freelancing gigs, all that good stuff.
Exactly. It not only boosts your income and also diversifies your sources of revenue, making you less vulnerable if one stream dries up during a recession.
It's like having multiple fishing lines in the water, right?
Hmm.
You're more likely to catch something even if one spot isn't biting. But finding the right side hustle can feel overwhelming. Any tips for narrowing it down?
Think about your skills, interests, and what you genuinely enjoy. What are you good at? What do you enjoy doing in your free time?
So it's not just about making extra money. It's about finding something that's actually enjoyable, something that doesn't feel like a chore.
Precisely. Maybe you're great at writing, graphic design, or even dog walking. Turn your passions into profit.
I like that. Okay, so we're financially prepared. We've got our side hustle going. What now? Do we just sit back and wait for the recession to hit?
Absolutely not. This is where we shift from defense to offense. Remember those buying opportunities we talked about earlier? A recession can be a fantastic time to invest, provided you're strategic about it.
Okay, I'm intrigued. But isn't it counterintuitive to invest when everyone else is panicking and pulling their money out?
That's precisely what creates the opportunity. When fear drives prices down, savvy investors recognize the chance to acquire assets at a discount. They see beyond the headlines and focus on the long-term potential. It's like shopping at a clearance sale. You wait for the prices to drop, and then you swoop in and get those great deals.
So it's about having the courage to zig when everyone else is zagging.
Precisely. But how do I know what to invest in during a recession? Isn't everything going down?
Right, that's what I'm wondering.
Well, remember those blue chip stocks we discussed? They often weather the storm better than others and can rebound strongly when the economy recovers. They're like those sturdy trees in the forest that can withstand a strong wind.
Okay, so blue chip stocks are a good bet during a recession. But even with those, isn't timing crucial? How do I know when to buy?
That's where research and a bit of patience come in. Look for companies with strong fundamentals, consistent earnings, and a history of performing well during previous recessions.
So it's like being a detective, looking for clues that indicate long-term value, even amidst the chaos of a recession. But what about other investment options? We talked about real estate earlier. Is that still a good bet during a recession?
It can be, especially if you're looking for long-term growth. As we discussed earlier, recessions can create attractive entry points in the real estate market, particularly for rental properties. But again, it's about being selective.
Right, location, location, location.
Exactly. Focus on properties in areas with stable employment and resilient industries. Those are the areas that are more likely to weather a recession without a significant drop in property values or rental demand.
Okay, so real estate is still on the table, but it requires some careful consideration. What about bonds? Those seemed like a safer option during uncertain times. Do they still hold up? during a recession?
Bonds can definitely play an important role in a diversified portfolio, especially during a recession. They tend to be less volatile than stocks and can provide a steady stream of income, which can be especially valuable when other investments are fluctuating.
So bonds for stability, stocks for potential growth. We covered that earlier. But I have to admit, I always thought bonds were pretty straightforward. You just buy them and collect your interest payments, right?
It's a bit more nuanced than that, especially during a recession. You see, interest rates often fluctuate during a recession, and those fluctuations can affect the value of your bonds.
Hold on, I thought bonds were supposed to be the safe investment. What kind of fluctuations are we talking about?
Well, for example, let's say interest rates go up during a recession. The value of your existing bonds, which were issued at a lower interest rate, might go down.
Okay, so rising interest rates are bad for bondholders. But what if interest rates go down? Wouldn't that be a good thing?
It can be, but it depends on the type of bonds you hold. For instance, short-term bonds mature faster, so they're less susceptible to interest rate fluctuations. On the other hand, long-term bonds, while offering higher potential returns, carry more interest rate risk.
So short-term bonds are like parking your money in a safe place for a bit, while long-term bonds are more of a long-term bet with potentially higher rewards but also higher risks.
That's a good way to think about it. The key is to choose bond types that align with your investment time frame and risk tolerance, especially during a recession when economic conditions are unpredictable.
This is all really helpful. It feels like we're going beyond the usual generic advice and getting into the nitty-gritty of how to actually navigate a recession strategically.
Yeah.
But let's face it, even with all the preparation and knowledge in the world, recessions can still be emotionally draining. Any tips for staying mentally resilient during those tough times?
You're right. The psychological aspect of investing is often overlooked. Remember, a recession is not just about numbers and charts. It affects real people's lives and livelihoods. So it's natural to feel stressed or anxious when your finances are impacted.
So it's okay to acknowledge those feelings and not pretend everything is fine.
Absolutely. Bottling up emotions only makes things worse. Acknowledge your fears, talk to someone you trust, and remember, you're not alone in this. Many people are going through similar challenges, and sharing your experiences can help alleviate the burden.
It's like that saying, a problem shared is a problem halved. Talking about it can help lighten the load. But what if talking isn't enough? What if the anxiety is really starting to affect my daily life?
Don't hesitate to seek professional help. Financial therapists specialize in helping people cope with the emotional and psychological impact of financial stress.
Financial therapists, huh? I've never heard of that.
They're becoming increasingly common, and they can be incredibly helpful. They can provide valuable tools and strategies for managing anxiety and making sound financial decisions, even during challenging times.
So it's like seeing a physical therapist for a financial injury. That makes a lot of sense. But besides talking to a professional, are there any self-care practices that can help during a recession? Things we can do on our own to manage stress and stay positive?
Absolutely. Prioritize activities that bring you joy and reduce stress. Maybe it's exercise, spending time in nature, reading, or listening to music. Taking care of your mental and emotional well-being is crucial for making clear-headed financial decisions. When you're stressed out, it's easy to make impulsive choices that you might regret later.
So it's not just about protecting your portfolio, it's about protecting your peace of mind too. I love that. But let's say I've done all that, I'm financially prepared, I'm investing strategically, and I'm taking care of my mental health. Is there anything else I can do to make the most of a recession?
One often overlooked aspect is using the recession as an opportunity for personal growth. Think of it as a financial boot camp, a chance to refine your budgeting skills, learn new investment strategies, and become more financially resilient.
So it's not just about surviving the recession, it's about using it as a springboard for personal development. That's a really empowering way to look at it. But how do I actually go about turning a recession into a learning experience?
There are tons of resources available: books, podcasts, online courses, even free webinars. Take advantage of this time to learn from financial experts, connect with other investors, and embrace the challenge as a chance to become more financially savvy.
So it's about turning a financial setback into a financial comeback story. I like that. But with so much information out there, how do I know what to focus on?
Start by identifying your knowledge gaps. Are you unsure about asset allocation? Do you want to learn more about specific investment strategies? Maybe you're interested in real estate investing or starting a side hustle. Once you've pinpointed your areas of interest, you can tailor your learning journey accordingly.
So it's about creating a personalized financial curriculum, so to speak. But with all this talk about learning and strategizing, it's easy to get caught up in the numbers and forget the bigger picture. What's the ultimate goal of navigating a recession successfully?
It's not just about preserving wealth or even growing it. It's about building a life of financial security and freedom, one that allows you to pursue your passions, support your loved ones, and weather any storm that comes your way.
That's a beautiful way to put it. It's not just about the money, it's about the life you're building with it. And that's something worth fighting for, even during a recession.
Absolutely. Remember, financial resilience is not just about surviving, it's about thriving. And with the right mindset, strategies, and support, you can emerge from a recession stronger and more empowered than ever before.
This has been such an insightful conversation. I feel like we've gone beyond the usual doom and gloom of recession talk and uncovered a whole new perspective on how to approach these challenging times. But before we wrap up this part of our deep dive, I want to circle back to something we briefly touched on earlier, the importance of seeking expert guidance during a recession.
Absolutely. Navigating a recession can be complex, and having a trusted financial advisor in your corner can make all the difference. They can help you develop a personalized plan, navigate market volatility, and make informed decisions that align with your long-term goals.
It's like having a seasoned guide leading you through uncharted territory. But finding the right financial advisor can feel overwhelming. There's so many out there. What should people look for when choosing someone to guide them through a recession?
You're right. It's important to be selective. First and foremost, look for someone with experience navigating past recessions. They've seen it all before, they know how markets behave during downturns, and they can provide valuable insights based on real-world experience.
So it's like choosing a captain who's weathered many storms before. Makes sense. But beyond experience, what other qualities are important in a financial advisor, especially during a recession?
Look for someone who is a good communicator, someone who can explain complex financial concepts in a way that you understand. They should be able to break things down into simple terms and answer your questions clearly and thoroughly. And they should also be a good listener, someone who takes the time to understand your individual needs, goals, and risk tolerance.
So it's not just about their technical expertise, it's about their ability to connect with you on a personal level. You need to feel like you're on the same page, that you're working together towards a shared goal. But how can you tell if you're truly comfortable with an advisor? I mean, it's not always easy to judge someone's character in a short meeting.
You're right. Trust your gut feeling. Do you feel like they're genuinely interested in helping you? Do you feel like you can be open and honest with them about your financial situation and concerns? If something feels off, it probably is. Don't be afraid to shop around and interview multiple advisors before making a decision.
So it's like any relationship, there needs to be trust and mutual respect. But let's say you found an advisor who ticks all the boxes. What kind of practical support can they offer during a recession? What can they actually do to help you navigate those choppy waters?
A good financial advisor can help you with a wide range of tasks, from reviewing your budget and debt management strategies to rebalancing your investment portfolio and exploring new investment opportunities that may arise during a recession. They can also act as a sounding board for your ideas, provide a reality check when needed, and help you stay focused on your long-term goals.
So they're like a financial Swiss Army knife, equipped to handle a variety of challenges. But let's be honest, financial advisors can be expensive. Is it really worth the cost? Especially during a recession when finances are tight.
It's a valid concern. However, a good financial advisor can potentially save you money and stress in the long run. They can help you avoid costly mistakes, identify opportunities you might otherwise miss, and provide peace of mind knowing that you have an expert guiding you through turbulent times.
So it's like investing in a financial safety net. You're paying for expertise, guidance, and peace of mind, which can be invaluable during a recession.
Exactly. And remember, you don't have to commit to a long-term contract. You can always start with a consultation to see if an advisor is a good fit for you. See how you feel about their approach, their communication style, and whether you feel comfortable sharing your financial details with them.
That's great advice. It takes the pressure off and allows you to test the waters before diving in. But let's say you've decided to work with an advisor. What's the best way to make the most of that relationship, especially during a recession? How can you ensure that you're both on the same page and working together effectively?
Be open and honest with your advisor about your financial situation, goals, and concerns. The more information you provide, the better they can tailor their advice to your specific needs. Remember, they're not mind readers. They need you to be upfront about your financial history, your current situation, and your aspirations for the future.
So it's like going to the doctor. The more you tell them, the better they can diagnose and treat you. But what about those awkward money conversations? I mean, talking about finances can be really uncomfortable for some people. Any tips for making those conversations easier?
Remember, a good financial advisor is there to help you, not judge you. They've likely heard it all before, and they're trained to handle these conversations with sensitivity and professionalism. Think of them as your financial confidant, someone you can trust with your money worries and aspirations.
So like going to a therapist for your finances, a safe space to talk about your money worries without judgment. But what if I'm still hesitant to open up? Any practical icebreakers to get the conversation flowing? I mean, sometimes it's hard to know where to even begin.
Start by focusing on your goals. What do you want to achieve financially? What are your biggest concerns about the recession? Framing the conversation around your aspirations can help ease the awkwardness and create a more productive dialogue. Instead of dwelling on past mistakes or current anxieties, shift the focus to what you want to accomplish and how your advisor can help you get there.
So it's about shifting the focus from I'm bad with money to I want to achieve these things. That's a great mindset shift. But what about those ongoing check-ins? How often should I be talking to my advisor during a recession? Is it like a weekly call, a monthly meeting, or just whenever something comes up?
The frequency of communication depends on your needs and preferences. Some people prefer regular check-ins, maybe monthly or quarterly, to review their portfolio, discuss market conditions, and make any necessary adjustments to their financial plan. Others prefer to reach out only when they have specific questions or concerns. The key is to have open lines of communication and feel comfortable reaching out to your advisor whenever you need guidance or reassurance.
So it's like having a financial lifeline you can access whenever you need it. That's reassuring. But let's be real, working with a financial advisor isn't a magic bullet. They can't predict the future or guarantee returns. What's a realistic expectation for what an advisor can and cannot do for me during a recession?
That's a crucial point. A good financial advisor can provide valuable insights, guidance, and support, but ultimately, the decisions are yours. They can't force you to follow their advice, and they can't control the market.
So it's a partnership, not a dictatorship. They provide the roadmap, but I'm the one behind the wheel.
Precisely. A good advisor will empower you to make informed decisions, but they won't make those decisions for you. And they'll be there to support you every step of the way, through the ups and the downs.
But even with a good advisor, navigating a recession can be a bumpy ride. Any final words of wisdom to help our listeners stay the course? How do we stay focused, motivated, and optimistic when things get tough?
Remember, recessions are a natural part of the economic cycle. They've happened before, and they'll happen again. The key is to approach them with a proactive mindset, a well-defined strategy, and a willingness to seek expert guidance when needed. And above all, don't let fear paralyze you. Recessions can create opportunities as well as challenges. It's up to you to seize those opportunities and turn them into advantages.
That's such an empowering message. It's not about hiding from the storm. It's about learning how to sail through it. And with the right tools and the right mindset, you can come out stronger on the other side.
Exactly. With the right tools and mindset, you can not only weather the recession, but potentially emerge stronger and more financially resilient on the other side.
This has been an incredible deep dive into the world of investing during a recession. We've covered a lot of ground, from practical tips to emotional strategies to the importance of seeking expert guidance. But before we wrap up this episode, I want to leave our listeners with one final thought. So much to think about after that last segment. You know, as we've gone through this deep dive, I've noticed something. We've talked a lot about the nuts and bolts of investing during a recession, but what really sticks with me is this whole idea of shifting our mindset. It's not just about weathering the storm, it's about using it as a chance to grow, to become even more resilient.
You hit the nail on the head. Recessions can be tough, no doubt about it. But they also offer a unique opportunity to take stock, reevaluate priorities, and come out stronger on the other side. Think of it like a financial fitness test. It might be grueling while you're going through it, but it ultimately makes you healthier in the long run.
Okay, I like that analogy. So let's get practical for a minute. What are some concrete steps our listeners can take, not just to survive, but to really thrive during a recession?
Well, I'd say one of the most powerful things you can do is focus on what's within your control. You can't control the global economy or the stock market for that matter, but you can control your own spending habits, your savings, and how you invest your money.
Okay, so take back the reins, so to speak. Don't just let the recession happen to you, but make conscious choices to manage it.
Exactly. Recessions can be scary, but remember, they don't last forever. And often, amidst all the chaos, there are opportunities for growth and innovation.
Ah, yes, every cloud has a silver lining. But how do we find those silver linings during a recession? Where do we even begin to look for those opportunities?
Keep an eye out for those emerging trends, those industries that are likely to thrive even during a downturn. Think back to the last recession, for example. We saw a surge in online businesses, healthcare services, those home improvement companies, remember?
Right, right. Those were the ones meeting those essential needs, the ones who were able to adapt to how consumer behavior was changing.
Precisely. So do your research, pay attention to what people are buying, and look for those pockets of growth even when the broader economy is slowing down.
So be a trend spotter, do your homework, and then what? How do we actually translate those trends into investment opportunities?
That's where our old friend diversification comes in. Spread your investments across different asset classes, sectors, maybe even different geographic regions. This helps to manage risk and allows you to capture potential gains from those up-and-coming trends we talked about.
Okay, so build that diversified portfolio that's both recession-proof and future-focused, but that can feel overwhelming, especially for someone who's not a financial whiz. Any advice for getting started?
Well, a good first step is to take a look at your current portfolio. Is it really diversified, or are you heavily invested in just a few sectors? Think about rebalancing your portfolio to include some of those recession-resistant sectors we discussed earlier. Consumer staples, healthcare, maybe even some real estate.
Okay, so fine-tune those investments. Make sure they align with our new recession-ready strategy. But what if you're starting from scratch?
There are some really great resources out there for new investors. Robo-advisors, for example, can help you build a diversified portfolio based on your risk tolerance and goals. And of course, there's always the option of working with a financial advisor who can offer personalized recommendations.
Right, those financial experts we talked about earlier. Okay, so find those tools, find that support, and build a portfolio that reflects your individual needs. But beyond investments, are there other areas where we can focus our energy during a recession, things that can set us up for success down the road?
Absolutely. Recessions can actually be a great time to invest in yourself. Think about your skills, your knowledge, your professional development, maybe take some online courses, attend webinars, learn a new language, anything that can enhance your career prospects.
So it's like taking advantage of a downtime in the economy to create an uptime for your own personal growth. I like that.
Exactly. Think about how those new skills and knowledge can boost your earning potential and make you more competitive in the job market once the economy recovers. It's all about playing the long game.
Okay, so invest in your skills, invest in your knowledge. But let's be honest, it can be tough to find that motivation when you're feeling stressed and uncertain about the future. Any tips for staying motivated during a recession? How do we avoid just curling up on the couch and binge watching the latest reality TV show?
Focus on those long-term benefits. Think about how acquiring those new skills can help you achieve your goals, whether it's landing a better job, starting your own business, or simply having more financial security. And remember, even small steps forward can make a big difference over time. Don't underestimate the power of consistency.
So it's about shifting your perspective from I have to do this to this will benefit me in the long run.
Precisely. And don't forget to celebrate those small wins along the way. Acknowledge your progress, reward yourself for your efforts, and keep that momentum going.
Okay, so we're upskilling, we're staying motivated, but what about our overall well-being? I mean, recessions can be emotionally draining. How do we take care of ourselves, not just financially, but mentally and emotionally during these tough times?
That's a great point. Recessions can be a time of introspection and reevaluation. It's a chance to take stock, not just of your finances, but of your life as a whole. What are your values? What truly matters to you? This period of reflection can lead to personal breakthroughs, a renewed sense of purpose, and a deeper understanding of what you want out of life.
So it's not just about your financial portfolio, it's about your personal portfolio too.
Exactly. It's about finding that balance, that sense of wholeness that allows you to navigate challenges with greater resilience and emerge from those challenges even stronger.
Okay, so we're investing in ourselves, we're reflecting on our values, we're finding that inner strength. But let's be real, even with all this talk about opportunity and growth, recessions can be tough. People lose jobs, businesses struggle, and it can feel like the world is falling apart. Any final words of encouragement for our listeners who might be feeling overwhelmed by the current economic climate? How do we stay hopeful when things feel so uncertain?
Remember, you're not alone. Recessions are a shared experience. We're all in this together. Lean on your support network, talk to your friends and family, seek out professional guidance if needed. And most importantly, don't lose hope. Recessions are cyclical. They don't last forever. And just as the sun always rises after the darkest night, so too will the economy eventually recover.
What a beautiful and inspiring message, It's not about denying the challenges, but about finding that inner strength, that resilience to not just weather the storm, but to emerge from it even stronger.
Precisely.
Hmm.
And remember, financial resilience is not just about surviving, it's about thriving. And with the right mindset, strategies, and support, you can not only navigate the recession, but you can actually achieve even greater financial success and personal fulfillment than you ever thought possible.
Wow, that's a powerful message to end on. Thank you so much for sharing your expertise, your insights, and your inspiring words with us today. I know I've learned a lot, and I'm sure our listeners have too.
It's been my pleasure. And to all our listeners out there, remember, you have the power to shape your financial future, even during a recession. Stay informed, stay proactive, and never stop believing in your ability to thrive.
That's it for this deep dive into investing during a recession. We hope you found it informative, inspiring, and most importantly, empowering. Remember, knowledge is power, and with the right tools and mindset, you can navigate any financial storm that comes your way. Thanks for joining us, and we'll catch you on the next deep dive.